All right, welcome to this explainer. Today we're strapping in for a really high-yield approaching session focused squarely on two of the biggest, absolutely most critical profit-driving decisions in the ACCA performance management syllabus. We're talking about resource scarcity and pricing strategy. Look, if you want to conquer the PM exam and, let's face it, just survive the syllabus, you really have to know how to maximize profit when the odds are completely stacked against you. And you need to know exactly how to price your products to capture maximum value. Okay, let's dive right into this.
So, here's our game plan for today. First, the profit maximization problem. Second, limiting factors and linear programming. Third, pricing decisions looking at both demand and cost. And finally, exam tricks and execution to make sure you actually secure those marks.
Section 1. The profit maximization problem. What to make and what to charge. You know, in a perfect world, a business has infinite resources and infinite demand. But we operate in a reality that's governed by constraints. Driving profit isn't just about selling more stuff. It's about optimizing the very specific variables you actually have control over when everything else is restricted. So I want you to think about this question for a second. What do you do when you run out of labor or materials? Imagine your customers are practically knocking down the door, but your factory only has 100 hours of machine time available this week. Or maybe a global supply chain issue means you only have 50 kilograms of a really crucial raw material. How do you decide which products get made and which ones just get left on the cutting room floor? This right here is the classic problem of bottlenecks.
Which brings us to Section 2, Limiting Factors and Linear Programming, Conquering Resource Constraints. This is where we conquer those constraints, using pure math and strategic logic. When you hit a bottleneck, your entire production strategy has to pivot. You're no longer just looking at what makes the most money overall. You are looking at what makes the most money relative to the exact thing that is holding you back. If you remember only one single thing from this entire explainer about single limiting factors, please let it be this golden rule. Maximize contribution per unit of bottleneck resource. Notice we are not maximizing profit per unit. No way. We're maximizing contribution per unit of the bottleneck. So, if machine hours are holding you back, you want to produce the item that gives you the absolute highest contribution for every single hour that machine is running. Okay, let's break this down into the exact step-by-step flow you're going to need for the exam. Step 1, identify the limiting factor. Is it labor? Is it materials? Step 2, calculate the basic contribution per unit for each product. Remember, that's just selling price minus variable cost. Step 3, calculate the contribution per limiting factor. This basically means dividing the unit contribution by the amount of the scarce resource it actually takes to make one unit. Step 4, rank them. The highest contribution per limiting factor gets rank number 1. And finally, step 5, allocate your scarce resource to the highest rank until it's entirely used up. Now pay super close attention to step 4. The single most common mistake here is ranking by contribution per unit. Don't do it. Always, always rank by the bottleneck.
But what happens when the real world gets even messier? What if you're short on labor and you're short on materials at the exact same time? Well, when a company faces more than one constraint like that, the simple ranking method totally breaks down. We have to level up our strategy to linear programming.
Now, I know linear programming might sound a little intimidating. It's usually the part of the syllabus where everyone suddenly hates math. But trust me, it follows a really logical 4-step process. First up, you identify your constraints and translate them into mathematical inequalities. Second, you formulate your objective function, which, by the way, is always to maximize total contribution. Third, you solve the problem. You can do this either graphically by drawing out the constraints or algebraically using simultaneous equations. And fourth, you identify the optimal production mix. The really crucial point to remember here is that your optimal production point is almost always going to lie at the exact intersection of your constraint lines on a graph. That intersection is the sweet spot where you're maximizing both scarce resources simultaneously.
Moving right along to Section 3. Pricing decisions. Setting the perfect price tag.
All right, so we've optimized the production floor, but now we've got to optimize our sales. Creating the right product mix is really only half the battle. Setting the perfect price tag is what actually captures the profit. We need to look at this from two different angles, demand and cost. Let's start with demand-based pricing, which is entirely driven by customer sensitivity. We measure this using price elasticity of demand, or PED. If demand is elastic, it means your customers are highly sensitive. You raise the price even a tiny bit, and demand drops significantly. But if demand is inelastic, your customers are super loyal, or maybe the product is just an absolute necessity. In that case, you can raise the price, and demand will only drop a little bit. Understanding your PED completely dictates your entire pricing strategy.
Now, when you're using demand-based pricing, there is an absolute, undeniable mathematical rule for finding that perfect profit-maximizing price. It's the optimal output rule, MR equals MC. Marginal revenue must equal marginal cost. Seriously, if the revenue you get from selling one more unit is exactly equal to the cost of making that one extra unit, you have hit the absolute peak of your profit curve. Burn this rule into your brains, folks. To actually find that MR equals MC point, you're often going to have to work with the linear demand curve equation, P equals A minus BQ. A is the price where demand hits zero, and B is the change in price divided by the change in quantity. Remember that total revenue is just price times quantity. The exam is very often going to give you this exact demand equation and ask you to calculate the optimal price point by deriving the marginal revenue and setting it perfectly equal to your marginal cost.
Okay, let's flip the script and contrast that with cost-based pricing. This is a lot simpler, but, it comes with some serious trade-offs. The two main methods here are full cost plus and marginal cost plus. Full cost plus is highly advantageous because, well, it's simple and it guarantees all your costs are covered. But its massive disadvantage is that it completely ignores what the customer is actually willing to pay. It totally ignores demand. Marginal cost plus, on the other hand, is absolutely brilliant for short-term special orders where you just want to generate a little extra contribution. But it's pretty dangerous long-term because it might just fail to cover your fixed overheads.
And this really brilliantly illustrates the mechanical difference between the two. Full cost plus takes your full cost per unit, so that's variable plus fixed overheads, and adds a percentage markup. It puts a markup on literally everything. Marginal cost plus only takes the variable marginal cost and adds a markup, which effectively serves as your contribution. So as a quick rule of thumb, full cost plus is your baseline for standard pricing, while marginal cost plus is your absolute go-to strategy for short-term, one-off special orders where you happen to have some spare capacity.
And that brings us to Section 4, Exam Tricks and Execution, Avoiding the Traps.
All right, we are in the final act here. You understand the theories of limiting factors and pricing, but actually passing the PM exam? That is all about execution. It's about knowing exactly where the examiner sets the traps and knowing exactly how to step right around them. Let's do a rapid-fire review of the absolute most common pitfalls. First up, ranking. I'm going to say it again. Always rank by contribution per limiting factor. If you rank by contribution per unit, your entire calculation is going to be wrong. Second, linear programming graphs. You absolutely must be comfortable drawing break-even and LP graphs using the specific computer-based exam or CBE tools. Please practice this before exam day. Third, for special pricing orders, if the scenario tells you there is spare capacity, immediately think of marginal cost plus. And finally, the most important exam technique of all, method marks. Show absolutely all of your workings. I literally cannot stress that enough. In the PM exam, method marks are a total lifesaver. Even if you mess up some early calculation and your final number is totally wrong, the examiner is going to follow your logic. If your logic and your steps are correct, you will still earn the vast majority of the marks.
Which brings us to our final thought. You know the models, now apply them. Performance management isn't just about memorizing some formulas, it's really about applying them to realistic business scenarios to make critical, strategic decisions. You now have the exact tools to handle resource scarcity and to set those optimal prices. But I want you to ask yourself this. If a major competitor slashes their prices tomorrow, do you know exactly how your profit margins are going to survive the impact? Trust these frameworks, show your logic clearly on the exam, and you are absolutely going to crush it. Thank you so much for joining me for this explainer.